So to talk more on how big, bold this budget would be in 2026, I have an eminent panel joining me to talk about their expectations and their key wish list. Aditi Nayar, Chief Economist at ICRA, Dr. Jaijit Bhattacharya, who's President of the Center for Digital Economy Policy Research, and we also have Mr. Ajay, Bagga, a very well-known market expert, and Executive Chairman of OPC Asset Solution. Thank you so much, all of you, for joining me. Aditi, let me start with you. One is, of course, the macro numbers, and then, of course, we get into the sectors. But I want to start with the big numbers there. You know, many feel this is Goldilocks moment for India. We've got the right GDP numbers, we've got right inflation numbers. Of course, a record FII pullout is a matter of concern. But how do you see India's fiscal math measuring up this year?
So, thank you so much. Let me start with FY26. We are not expecting a fiscal slippage. Overall, there will be some hits and misses as far as the revenues and expenditures are concerned, but we're expecting the overall fiscal deficit to be in line with what was budgeted for this year. For FY27, we are now assuming that the budget will bake in about a 10 to 10.5% nominal GDP growth, given the kind of real growth that has been indicated by the Eco survey yesterday. And in our view, this is going to be a year where tax revenue growth will be a bit subdued. There will be an overhang from the GST side in particular, the rationalization as well as the cess going away. On the expenditure side, we are hoping that whatever space is there will get prioritized towards capex.
Okay.
1 percentage point reduction in the debt to GDP ratio, and we believe that a 4.3% of GDP fiscal deficit is tenable with all of these assumptions.
So I'll tell you why I feel that the debt to GDP numbers coming down could be tricky is simply because there are 5 very important state elections this year, and at the end of the day, that trade-off is what essentially the budget making exercise is all about. But Dr. Bhattacharya, I want to bring you in on your expectations in terms of what do you think the priority or the focus areas could be for the FM this year. There is a growth momentum going, so there are tailwinds there, but at the same time there are global political headwinds as well.
Yeah, I totally agree, and I was going to amplify what you just said a little while ago. There are also pressures because of the geopolitics in terms of increased defense spending. So there are large holes that have suddenly come up, and therefore it will be difficult for the government to balance without increasing a bit of the debt to GDP. But thankfully we are back on the same glide path as we were in terms of fiscal deficit before COVID happened, which is almost a sign that we have been able to absorb the total impact of COVID in the 5 years since COVID got over. So those are positive signs. So we are back onto the growth track. But if I go back to what the economic service said, is that the cost of capital in this economy is going up because of the current account deficit. And that's a big hole again. If you look at the current account deficit with just China, it's $100 billion. And the budget is the right time to actually address this. There are structural cost differences between India and China. And clearly the deficit with China in terms of trade is one of the elephants in the room. We need to address it in order to have a secular continued growth for India, which is sustainable. And therefore, some of the the basic custom duty interventions needs to be made in areas such as viscose filament yarn or PNCB and isopropyl alcohol, which are critical for downstream pharmaceuticals, for our energy security.
So if I were to just take on the custom duty bit, just to simplify and to tell our viewers, yesterday you had the chief economic advisor saying that Swadeshi is a very legit economic tool in times of global political turmoil that we are seeing. Is that then a precursor to India now ensuring that it gives more bulwarks to its sectors that are going to be most exposed, whether it's leather, toys, footwear, textiles, all of those sectors?
Absolutely, yes. And I also would like to add that people should not confuse between Swadeshi and License Raj. So in the 60s, we were brought down not because of Swadeshi, but because of License Raj. There has to be a extreme competition in this country, but with a focus on ensuring that there is domestic production and domestic capacities. Because of activities such as dumping by imports, we end up destroying our capacities. In fact, another source is saying that when war happens, people put bombs on each other's factories. But what is happening now is adversities are bringing down their prices so that the factories become unviable and therefore the capacities are getting destroyed without throwing. And hence the budget comes in as the Sudarshan Chakra. It protects and safeguards our capacities, and that's very critical as we move forward.
All right. Mr. Bagga, let me bring you in on the other side to it, which is that what is it that markets, global investors are looking at in this budget? There has been a record FII pullout, $18 billion no less. We have a rupee that is under pressure. And that, of course, adds up to our overall economic math. But from a larger point of view, what is that big thing that global investors are really looking for in this budget?
Yeah, see, global investors are largely looking for policy continuity and, tax regime which is predictable, which is long term. The other thing that has really led to the Indian market's underperformance has been the relative overvaluation of India, the lack of pure play AI companies. So even though emerging markets outperformed last year, emerging markets as a cohort were up 34%, we saw India underperforming, and we saw consistent FPI outflows. Where did the flows go? They went into China, into the new age Chinese companies. It went to Korea. Korea is basically a two-company market. If you look at the performance, 73% up for the Kospi last year was largely because of Samsung and SK Hynix. So it was a semiconductor AI place and Japan. That's where the money went. So that I don't see it getting addressed in the budget. I would say we missed a bus in 2019 when first time the Trump tariffs came up. China unleashed a 35-point program of 35 things that they had to get self-reliant or not reliant on the US economy for. They have delivered on that. We sat thinking that we will be able to negotiate our way through. This budget is a small step, but I think the bigger issue for us will be to what the economic survey mentioned, bringing up that Swadeshi. We need to have a 20-30 point module like the Chinese did over the last 6 years. All
right. Aditi, do you expect that big 30-point program to be outlined in the budget, essentially setting the roadmap for our manufacturing sector, for our overall, maybe even PLI scheme? It could be expanded to include some of the other sectors. Right now, it's done wonders, but only in electronics per se. Maybe that could be expanded. That could be part of the overall 2030 roadmap, so to say.
Sure, it could. I mean, see, in the budget, anything, any reform or any policy that needs to have an expenditure outlay needs to be put into the budget. Otherwise, the whole year is there. Reforms and new schemes can be announced at any point in time. The budget itself doesn't have to be the only day on which all of this is brought in by the government. Here, I think, coming back to what I was saying earlier, there is a target to reduce the debt to GDP to 50 plus minus 1% in a few years, and looking at where bond yields are, looking at where we are fearing the overall government borrowings are going to end up next year. I think it will be very important for the government to show a reduction in the debt to GDP ratio. Otherwise, yields could go up further.
And to simplify it for our viewers, Aditi, you're making a very valid point, but just to very simply, put this out for our viewers. When government starts borrowing at a very large scale, what happens is that private sector, it sort of crowds out money that's available for private sector, which means that they're not able to get money, or they get it at very expensive rates. This year, the borrowings are likely to be about $17 billion. There could be about $12 to $13 billion add for states as well. So $30 billion is a very large amount that Aditi is referring to in terms of how it has a larger impact. But Jaijit Bhattacharya, I want to bring you in on two aspects which I think are very important and could be reflected in the budget. First is the fact that this is the first budget after Operation Sindoor. The government has made it very clear Operation Sindoor is still underway. Indigenous defense manufacturing is now a very integral part of our national security aspirations. How important do you think defense outlay is going to be, and are we going to breach that 25% levels that we have in terms of capex?
So, as you rightly said, defense is going to be critical, and that's the black swan that's impacting the budgeting process. For sure, we need very immediate and large sums of investments into defense. Will the government be able to balance it in a manner that we still don't breach our fiscal deficit goals? I believe the government should be able to pull it off, which means that there would be curtailments elsewhere. But as we see that there has been, I believe, about 4 times increase in capital investments since 2018 by the government. So there is already very significant amount of investment that has been made into both physical infrastructure, which is ports and roads and so on, as well as a lot of digital infrastructure has been invested into.
Okay.
I think Bharat 3 is a great example. So I think the government will end up doing a balancing act, and also a lot of the defense procurement, the payments may not go immediately in this year.
Yes.
So we'll have time in the next 1 to 2 years, 3 years to actually balance the accounts,
okay,
and make sure that we stay within the fiscal deficit glide path.
All right. So India does have one of the largest defense budgets in the world, but a lot of it actually goes in pensions, salaries and operational expenses, and not so much on capex and building defense manufacturing, which is what the long recurring concern has been. Mr. Bagga, let me, before I wrap this up, let me give you the final word here, which is that this is the first budget after Donald Trump's 50% tariffs. Also the first budget since India decided to, diversify its trade ties, signed up a mother of all trade deals with EU, did one with UK as well. Do you see that commentary, that roadmap to be reflected in the budget as well?
Yeah, definitely. It's a very good point. I think textiles, gems, jewelry, leather goods, specialty chemicals, intermediate machinery, expect some packages for all these which have been impacted by the US tariffs. So expecting something, especially for textile, it's a very huge job employer. Construction is taken care of in the infrastructure budget. So expect these impacted sectors to get a package.
Okay.
Overall, I think we will get a 4.2 odd fiscal deficit number. I'm looking also, Gaurie, at if we will get a disinvestment target which is higher. There's 40 lakh crores which the government owns in the stock market, and you have very good examples like Hindustan Zinc or Nirmala and all. So if the government goes for that and takes a higher target, I think that will be very positive for the market.
All right, I'm going to leave it there. Thanks much, all three of you, for joining in this very special edition of India Sense. All eyes now on Nirmala Sitharaman's Bai Khata and what does it have in store. Thank you so much for joining me.